This is Quint Beeler with a comment on building equity. The subject is from Chapter 1, the accounting equation, and I'd like you to take the viewpoint of the owner when studying this chapter. So what is equity? Well, it's the net worth of the owner in the business, the owner's claim to the assets. Again, assets are on the left side of the equation. When we subtract liabilities from it, owner's equity is the residual owner's interest. So the OE category is on the right side of the equation. All claims to assets are on the right side. Again, the generic equation is wealth equals parties who have claims to assets. Is owner equity an asset? No, it is not. It's not the real thing. It's only a claim or property right, but very important to the owner. It shows them the owner's net worth in the business. Diagram of our accounting equation. Assets on the left, the real thing, items of value, and liability positions and owner's equity positions. Both are claims on the assets on the left. The equation always stays in balance. We looked at the expanded equation in a previous lecture. VERA expands the activities, the four activities that change owner's equity. Investments by the owners increases it. Expenses decrease owner's equity. Revenues or sales increase owner equity, and takeaways, withdrawals, reduce owner's equity. So what's the owner's desire? To build equity in the business. What does this exactly mean? To increase the value of the business due to owner-directed actions. The owner wants to increase assets controlled by the business, as shown on the left side, by making a profit. Correspondingly, we increase the owner's equity category when profit is generated on the right side, the measurement side. That's where accountants keep score, the right side of the equation. All increases or all decreases to assets are mirrored by the changing of claims on the right-hand side. The right-hand side details reasons why assets change on the left side. So again, back to our basic accounting diagram. The owner's desire is to grow assets due to profit-seeking activities. As we expand assets, we expand owner's equity when profit is made, as measured by what? The E and the R of VERA. Revenues, a measure of assets increasing due to sales, and expenses, a measure of assets decreasing due to use of assets. That creates wealth. Can assets be grown apart from making a profit? The answer is yes, but either the business has to take a loan to increase assets, or the owner has to make another investment to increase assets. The problem is the loan has to be paid back, and continued owner investments in the business gets tiring. The owner, in effect, has to take personal assets and put them in the business as new investments. As he transfers these assets, they're in the control of the business and out of his personal control. Well, let me show you here. The assets can grow by taking out loans. We increase assets, but we increase our liability position. Taking out loans has no effect on owner's equity. Furthermore, they have to be paid back, reducing assets and then reducing the liability position upon maturity. We can also grow assets by, as mentioned, the owner investing more of their own personal assets. So as assets goes up, owner's equity increases because of the V, the investment. Again, this growth of assets is not the desirable portion. These assets are put at risk. The owner would rather grow the assets by the E and the R, revenues minus expenses. Here's an example. During the year, the ACCT company earned revenues of $50,000, had expenses of $31,000, purchased assets with a cost of $5,000, and had owner's drawings of $3,000. Question, what is the net income for the year? All we have to do is look at the revenue minus expenses. $50,000 minus 31, $19,000 is the net income for the year. Drawings do not affect net income. They are a reduction of assets, but not due to attempting to generate sales. They are a voluntary withdrawal of assets by the owner. Neither is purchase of an asset. That's just an exchange of assets. The purchased asset would increase on the left-hand side and cash would decrease as it's bought. Purchased assets do not affect owner's equity. Another example, same data, but we added one more information element. Let's say the company, our ACCT company, started the year with total owner's equity category of $25,000. And during the year, they had the activity as shown at the top. The question is, what is the owner's equity balance at year end? Now it's the beginning equity, $25,000, plus net income, 50 minus 31, or $19,000 net income, minus drawings of $3,000, or $41,000 ending equity. Again, the purchase of assets does not affect owner's equity. Just working the VERA activities, investments by owner, E&R is the net income effect, and drawings are the takeaway, change the balance in owner's equity during the year. A generic equation here, bringing in the basic equation, assets equals liabilities plus equity positions. Take an example of $100,000 in assets, and liability positions are $40,000, and the owner's equity position is $60,000 at the beginning of the year. And during the year, we're given just two pieces of information. Total liabilities decreased $10,000, and total equity increased $5,000. Question, can we determine the ending asset amount at year end? The answer is yes. Assets changed by a decrease of $5,000. If you look at the liability position change and the equity position change separately, we simply see that when liabilities go down, it took assets to reduce them. So assets will go down by $10,000. And separately, as owner's equity goes up, so does assets. And so we net the two. Assets would reduce by $5,000 or $95,000. We can see that it can be arrived at by two ways. One, just by bringing in the ending position of liabilities from 40, a decrease of 10 down to 30 at year end. Equity beginning of 60, increase of 5 up to $65,000, and then simply balance the equation. 65 plus 30 on the right equals $95,000 of assets on the left. Again, in this position, assets is calculated last. It must balance the equation. All changes in the right-hand side of the equation must mirror changes on the left-hand side. As assets change in total on the left-hand side, something on the right-hand side changes. Our basic equation, assets, and the accountability for assets, claims on the right-hand side. Asset amounts either represent creditor claims, called liabilities, or owner claims, called owner equity. If you can understand the changes to owner equity out of Chapter 1, you'll learn a very valuable lesson for this chapter. Again, owners prefer to build their equity by producing profits. As assets increase on the left side due to earnings process, and any sale is an exchange process, more assets are coming in than are spent, that change is measured on the right-hand side in the owner's equity category in the revenue and expense accounts. Those revenue and expense accounts comprise the income statement, the very first financial report that's pulled off at period end.